Good morning, everyone, and welcome to our Amati AIM IHT portfolio service update. My name is John Woolley. I'm part of the sales and marketing team here at Amati. First of all, just say thank you all for joining our webinar this morning. It's much appreciated. And presenting today, we have both Jourdan and Scott McKenzie. Both are members of our UK smaller companies team. But as I said, the focus today is on our AIM IHT service. And I'm sure many of you have noticed it's been quite a torrid and difficult time for investors performance-wise in UK small cap generally, and in particular in AIM over the last sort of 12 months. So what Paul's going to do is the presentation to do in the first half is to put that performance in context and put it in context historically. What's been worrying markets, obviously there's lots to worry about. Is there real value starting to emerge in the asset class now? And then the second half of the presentation, Scott will take over, and this is more specific to the portfolio itself. What's performance been like, what's been the activity we're doing, and kind of thoughts looking forward. Presentation should last about 35-40 minutes. Please do submit your questions, which we'll take at the end, but please submit them on the Bright Talk question bar there. We will try and answer all of those. If we don't answer your question, we will get back to you after the call. And for the purposes of this call, we'll probably keep the questions more investment orientated, if that's okay, as opposed to product orientated. So without further ado, I'll hand over to Paul.
Brilliant. Thanks very much, John. So I'm going to just set the scene a little bit of what's happened this year, and I'll try and keep it fairly snappy. This is the first slide we're going to go through here. This is just a quick reminder as to why we own small companies. This is the Numis Small Companies Index compared to the Numis Mid Cap and Numis Large Cap over a very long time period. And clearly this doesn't reflect the AIM market. That was only invented in 1995, but it just shows that in general you would expect to get a premium return for taking the liquidity risk, the illiquidity risk of investing in smaller companies. And by and large, the data over a very long period of time holds that out. So that's just a quick reminder. This only goes up to the end, of course, of 2021 when things look great. What's happened this year? It's been really an annus horribilis this year, and particularly so at this very small end of the market and in the AIM market, where the overall index is down 35% year to date. The small companies index down 25, and the mid cap down 26, whereas the large caps have barely moved. And of course, it's reflecting in quite big degree the very different makeup of the large cap index, which has a lot of energy, has a lot of large banks, which are beneficiaries of rising rates, and has a lot of consumer staples. So what is it that's been really worrying investors this year? And clearly no surprise to find out from this survey that Bank of America did of fund managers at the end of August, that inflation is right at the top of the list and became an even bigger worry in August than it was in July, and it's been climbing up the list all year. And we can see that quite a lot of the other things that are worrying investors are spillovers from that. Inflation being high, expectation of rates going up, that's hawkish central banks, that induces a global recession and creates systemic credit events. So you can see, almost all of the worry really is in investors is stemming from that source. One might think actually the Russia-Ukraine conflict is surprisingly small here. That is obviously still a major issue, and it's certainly very much on our minds. And of course, the Russia-Ukraine conflict itself created the energy crisis, which has contributed about half of the inflationary numbers that we've seen in Europe, and it's been a major factor and remains unpredictable. Right now, very glad to say that the gas crisis in Europe actually looks much better than could have been expected. Warm weather and plenty of wind has resulted in gas storage being pretty full across Europe. And the day-ahead gas price in the UK has been actually really very well down in the last few days, which is great news. This is a sentiment survey, Bank of America again, dating from the end of August. But you can just see how the reason we put this up is just to show how extreme bearish sentiment has become over the last few months. These are pretty rare moments in markets when sentiment reaches these kind of levels. This is a quick insight into past recessions. And it's a little bit of a technical slide, but the important one really to look at is the one on the left. What has happened historically in US markets during deep recessions. And you can see that over a period of about a year, from just before the recession started to 9 months in, there's been a fall of about 34% in that market. Of course, that doesn't predict the future, and of course, there are some that are worse than that, 1929 being one in particular. But it's an interesting piece of context, given that that roughly chimes with what we've seen in the UK AIM market so far this year. This slide has been the right at the heart of the drama over the past 6 weeks in the UK, and you can see on the left here how UK 10-year bond yields went from being well below US bond yields to actually rising above them on the 20th, by the 20th of October. Very glad to say that those have eased very significantly over the last week or so. That's hugely important, and it was no really big surprise that the bond market caused Parliament really to change tack completely in a very short space of time. Bond yields doing what they did. It's a major deal for the UK economy. It impacts absolutely everybody and every business. So the response we saw to it was completely understandable and necessary in every possible way. On the right-hand side, you can see what the gilt market is really forecasting interest rates to do over the coming period. And the dotted line there is the forecast according to the gilt market. And the solid line is where we're up to, so we're up to 2.25. It's was forecast in October, on the 20th of October, to go over 4. That'll be more like 3.7 probably now. I don't know the exact number, but the 10-year yield is down to 3.7. So that number will come off a bit. But importantly, you can see the expectation is for a big spike and then for rates to ease. And the big debate amongst economists now and the discussions around central bank policy are really very much around where do rates peak? Is this the right level? Some economists who, for those of you economically minded, that those who like to apply the Taylor rule would suggest that rates are going to go a lot higher than that. I personally don't think that's going to be the case. And if one attaches more importance to the money supply, which I think is the right way of analysing this, then I think rates in the UK and US are going to follow probably something like the pattern that's suggested here. So I don't think we've got a lot more pain to take from the bond market. I certainly hope so. Obviously subject to government policy being convincing and government being well run and the central bank being well run. And those are obviously important caveats to make, but this looks like a sensible projection, which does mean that the peak is kind of coming into sight, and that's very important. So it's a crucial dynamic. So once the peak is in sight, then debt becomes priceable again, and the future becomes a little bit more predictable than it's been in the last few months. Stagflation is unfortunately the kind of world we're entering into. Inflation is super high. It should come off next year. It won't get back down to 2% for really quite a long time, but it should start to decline, particularly obviously if energy prices come down. But setting aside the energy event, underlying inflation should also start to fall during the course of 2023. And but the growth, will there be enough growth to surpass the inflationary rate? It's going to take a while. So we're in a stagflationary environment. Yeah, we haven't been in one of those for a really very long time. Dollar strength has been the big story of 2022. Extraordinary dollar strength, partly the flight to quality, partly the very hawkish public stance of the Fed. This feels a little bit like it should have almost run its course. It's a little bit hard to imagine that this will be the story of next year. In fact, probably much more likely the story of 2023 is that this dollar strength unwinds to quite a big degree. And again, for context, we put this slide up. This is really looking at the UK small cap versus large cap in individual years. And you can see that 2022 has been one of the largest drawdowns that we've had. You've got to go back to 2008, 2002, 2001 to see similar events. And that's an important piece of context. The sector mix I mentioned earlier, just this is quite well known, but it's just pointing out here that within the FTSE 100, which are not the FTSE 100, within the Numis Large Cap Index, which are the grey bars here, you can see big weightings in energy, big weightings in consumer staples, and the financials weighting, which is also very large, is big banks, and the financials weighting in the NSCI plus AIM, excluding investment trusts, is much more the higher beta financials like asset managers, fund managers, wealth managers. So they don't quite compare in their makeup. And I think that to a very large degree it explains quite a lot of the discrepancy we've seen. But also, the reason we like the small company sector in general is that it's full of dynamic, many of the more dynamic sectors. And you can see here industrials, technology, communication services, the consumer discretionary. These are where a lot of growth companies lie, and in normal times these make very good investments. But we are subject to big setbacks like we've seen this year. And just finally, the UK market in a global context remains at a very significant discount to the US. Europe has kind of caught us up over the course of the past year. When we look back a year, we were trading at a discount to both Europe and the US. Now Europe has also derated very significantly, and that's got a lot to do with the energy crisis, which has taken a big toll on Europe, and particularly Germany. And this final slide, just looking more at the discrete components of the UK market, the small cap discount, which is really a long-running feature and an expected feature of the market, has really reasserted itself here. So you do get paid quite handsomely to take liquidity risk once again in this market, and actually at these kind of moments it can pay off very significantly to do so, even though few people have got the appetite to do it, but that's exactly why it can be an interesting opportunity. So with that, I will hand on to Scott to discuss the portfolio. Thanks very much.
Great, Paul. Thank you very much for that introduction and for giving it some context. The next section, we're just going to look at our AIM IHT portfolio service in more specific detail, what we've been doing with the portfolio and the drivers and dynamics of it. Just to give you some quick context from an Amati perspective, obviously Paul and I are part of the UK Smaller Companies team, and our UK Smaller Companies fund remains our largest fund within the stable at over £600 million. We also have our AIM VCT product range, which has been going for a number of years at just over £200 million. And the AIM IHT portfolio service that we're discussing this morning is the smaller of our three smaller company products, and one which we believe has a great deal of potential to grow. The current assets within the IHT portfolio service are just under £50 million at the moment. But we can see from the overall slide that UK smaller companies remains very much the core of what we do here at Amati. And in terms of the team who are managing the IHT portfolio service, in addition to myself and Paul, we have three other highly experienced members of the team. So a team of 5 people in total, specialising exclusively in UK smaller companies. So we believe that we're one of the best resource teams in the UK smaller company market. And between us, we have a wealth of experience over a number of years. We also aim to cover the entire waterfront of the UK smaller companies world, both in terms of main list and AIM. And to do so, we effectively split up the market into sectors. And you can see on the chart on slide 18, the various responsibilities that we all have. But in reality, the funds are very much managed on a team basis, on a collegiate basis, and we all support each other in these various sectors. We have our own proprietary database, Connex, which is effectively a database where we log all of our interactions with companies. And this has been going for many, many years now, and we have literally thousands of companies and thousands of interactions. So we have a very long history within the small companies world, and quite an exhaustive audit trail of everything we do, both individually and as a team. And that allows us to really challenge the ideas that the individuals are presenting to the team. And this process works for all of our small cap portfolios, the main smaller companies fund, the AIM IHT service, and also the venture capital trust. And just to give some basic background to the AIM IHT portfolio service as it is today, we're just under £50 million. So in the context of that market, we're still a relatively modest sized portfolio, and we do believe we've got considerable scope to grow that over the long run. There are a number of much larger services than ours at the moment. It's a focused portfolio. We typically have between 25 and 30 holdings, currently at 29, and it's very much focused on smaller cap, and obviously with AIM specifically. So the weighted average market capitalisation is £450 million. So we very much see our sweet spot within the portfolio as being in the kind of 100 million to 1 billion range. That's typically where most of our original investments will start their lives, and hopefully over time they will grow larger as the companies develop. So we're not really fishing in the very smallest companies. We tend to start around about the £100 million range. And to give this some context, the 50 million that we have within the service today is in the context of our total AUM of 950 million in UK smaller companies. So our AIM IHT portfolio benefits very much from the expertise we have in the larger funds too. And in terms of the history of the service, this just gives us some context both in the short and longer term. As Paul has already highlighted, it's been a very difficult year for AIM investors, and our fund has not been unscathed. Over the 1 year, although we've done better than the AIM benchmark, that we're still showing a fairly substantial loss, which is not what we're used to seeing. But over the longer run, we have consistently outperformed the main AIM benchmark, the Numis Alternative Markets benchmark, since launch over 3 years and 5 years as well. So we have a long, consistent track record of outperforming the benchmark. But obviously this year has been a particularly difficult period for all investors in AIM, and we're doing our best really to keep our heads above water in that pretty tricky environment. Paul has alluded to some of the sector differences already. This is looking specifically at our own benchmark and where the portfolio is. Obviously, we have business property rate eligibility to consider when we're constructing the portfolio, and there are a number of sectors which aren't allowed to be included within such a portfolio. So we typically would have very little in sectors such as real estate and energy. There are very few qualifying investments in those types of sectors, and a number of the financial service businesses, lots of the fund managers, for example, are also not allowed to be included in this service. So we do tend to have a bias towards higher growth companies and higher growth sectors within the portfolio. And you can see, looking at the red bars, that our main core are in the industrials, information technology and healthcare sectors. So if you add those together, that's over 60% of the current portfolio, and those are important drivers of long-term growth for the portfolio. So we think it's important that we're in growth sectors in this particular type of portfolio, and we're excluded from the more heavy industry type sectors anyway. So we'd expect to see that kind of profile overall be broadly similar in the years ahead. And in terms of the market capitalisation I made reference to a moment ago, we have only a small part of the portfolio which is less than 100 million, just under 8% at the moment. And obviously some of those, given the market falls this year, would have previously been higher than that. But as I made reference to a moment ago, our sweet spots really are in the kind of 100 to 1 billion category. And you can see those pie charts there, the grey, the black, and the kind of brown colour. Between them, those are almost 80% of the portfolio is in that 100 to 1 billion, and we do regard that as our natural hunting ground for this portfolio, and a real sweet spot in terms of the analysis that we do as a team. So really the vast majority of the portfolio would be between 100 million and a billion market capitalization. In terms of the style of the portfolio, we subscribe to a fairly major database, Style Analytics, which does exactly this for the portfolios. It looks at the key kind of style characteristics of the portfolio. And this is something that is used by a number of leading fund management businesses as well as ourselves. And you can see from the chart that they categorize the key style factors as they see them. And it was very helpful when we first took this service on that the analysis largely confirmed what we believed we were doing for clients in this service, and our focus remains predominantly on growth and quality factors, and those have come out in the analysis both currently and historically. The analysis compares our portfolio to the benchmark. So this would be the Numis Alternative Markets benchmark. So we are comparing like with like when we do this exercise. And some of the key characteristics are higher earnings growth and higher dividend growth. We regard that as very important for the long-term health of the portfolio. And also the quality factors in grey. Our companies typically have high returns on invested capital, very high profit margins, and low financial gearing. And in the current environment, we think that's even more important than it has been in the past. And if we are going into the recession that Paul was describing earlier, it's really important that we hold businesses that have got robust and high profit margins, and crucially important that they have balance sheet strength. And by and large, most of our companies do indeed have those characteristics. So again, if we were to look at this in the future, we believe that these are enduring characteristics that we should expect to see going forward. And a final point on volatility, typically our stocks are less volatile than the main alternative markets index. We're trying to find long-term growth companies. We tend not to be invested in cyclical businesses in this type of service. And to illustrate that point further, the Chord Quest database is another service that we use extensively in our analysis. And this really looks at some of those quality factors that I alluded to earlier. And really it takes the top 20%, the top quintile of the small company universe, and it analyzes the performance of the highest quality companies. And what we've found, shown by the red line over many, many years, going back over 20 years now, over time, high quality small companies deliver very strong performance. We may occasionally have the odd down dips from quarter to quarter, but over a very long time period, the red line demonstrates that focusing on the highest quality companies delivers the best returns, from a small cap strategy. So that's what we're aiming to do in all of our portfolios, including this one. So in terms of the portfolio specifics, how do we actually select the stocks and what type of companies do we invest in? And there are three main categories for this particular portfolio that we're interested in, and those are dominated by management and family ownership. We spend a lot of time looking at the co-investment of companies' managers and families with us as investors, and we're very keen to see meaningful equity ownership in the companies that we invest in for this service. So typically, at the moment we have almost 50% of the portfolio by value would fit that criteria. Begbie's Trainer, a company we've been investing in for many years in a number of our funds, and the Trainer family are have a significant stake in the business, and the chief executive also remains as part of the family as well. Young's has been going for over 200 years almost now. Again, the management and the family hold very, very substantial stakes for the long run, and we like to co-invest with companies of this ilk. The final example there is Craneware, a healthcare software company, originated ironically in Edinburgh, but actually is predominantly, almost exclusively, a US business these days. And again, we're co-investing with the chief executive and other managers who have very substantial equity stakes. So a very large part of the portfolio is in those type of companies, where we've got really strong management who are co-investing with us. And by and large, those types of companies tend to have very prudent balance sheets and are also able to pay, pretty solid dividends as well over the long run. The other two categories, durable defensive companies, almost what the name suggests. These are companies which have very solid growth prospects, but we expect to prosper regardless of the economic conditions. So these types of businesses, even in the current environment, we believe can still produce respectable earnings growth and growth in dividends, and quite often the dividend progression in companies such as Restore and Animal Care has been pretty impressive over the long run, and they may not be the most exciting companies on the market, but they're really there to form a backbone for the portfolio and continue to deliver in all circumstances. And the final category are what we call established technology companies. We do have a meaningful exposure to technology within the portfolio, but it's important to note that these are all highly profitable and well-established businesses. We're not investing in startup businesses in this fund at all, and typically we're not looking at early-stage companies. So the companies that we show here, Traxys and Gamma, are both long-established, well-respected businesses which have a long history of producing high returns and very strong cash flow. So important to note, when we do invest in technology, it's very much established, reliable businesses, such as Traxys and Gamma. So hopefully that gives us a flavour for the main kind of categories within the portfolio and the types of companies that we like to invest in. Just looking over the past year, it has actually been an exceptionally busy period for the portfolio. Typically, our turnover in the portfolio is quite modest, but the events of the past 12 months have necessitated a few changes. So this is a much busier slide than it would have been in previous years. And hopefully, as things calm down, we can get back to a more normal level of change within the portfolio. But you can see here that we have made quite a few changes over the past year or so. And the sales on the right-hand side, a lot of them happened in the earlier part of the current year, where we had to acknowledge that the market conditions had changed for some of the most highly rated companies in the market. So some of these businesses here, which we sold, businesses like AB Dynamics and Focusrite, very high quality companies, which we'd owned for many years, but we took the view that the valuations had become extremely stretched, in the bull market, and made sense for us to move on, to companies where valuations were more palatable. It's also worthy of note that we've had a couple of companies taken over within the portfolio as well over the past 12 months, CareTech and EMIS Group, both in the healthcare sector. We received pretty substantial premiums for those, and in the case of EMIS, it was particularly pleasing that it was a new investment for the fund earlier in the year. You can see that it's on the buy side of the equation, and within a matter of months, the company received a very substantial takeover bid, and we've now exited that. So that was a very profitable, if somewhat short-lived investment. And really on the buy side of things, we're just trying to make sure we keep looking at the three categories I mentioned earlier. We referred to Craneware, that came into the portfolio earlier in the year, but it's a business that we've known for a long time. It's been held in our other funds over a number of years, so well known to us already. But very much focusing on the three categories that I mentioned earlier. So overall, it's been a busy year. Market conditions have clearly changed quite dramatically, but we hope going forward to have a somewhat more stable portfolio. And just to kind of follow on from the previous comments, Paul shared some of the valuation aspects of where we are in smaller companies at the moment. And clearly valuations are now very depressed across UK smaller companies in general, and we've seen a very significant drawdown in the small cap and AIM markets in the current year. But we do take some heart from the fact that we are now seeing bid activity, and we've had 4 bid approaches in recent years within this portfolio. I mentioned CareTech and EMIS a moment ago, and we've also had a couple of our gaming businesses went in the last few years, Sumo and Codemasters. So we do believe that we're going to see more takeover bids, particularly at current depressed valuations, and the data suggests we're already seeing a fairly significant pickup in the current year. It may well be that there are some pauses in the short term in terms of the gilt yields and people working out where interest rates lie, but we do see a pretty strong uptick in M&A and bid activity coming in the months and years ahead. So that may well be another driver for the portfolio and its recovery going forward. And with that, I'll hand back to John, and we'll be happy to take any questions.
Okay, thank you, Scott. Thank you, Paul. Yeah, we do have a few questions that have come through. The first one, Paul, you kind of touched on, spoke about inflation. So the first one is relating to that and food inflation. So the question is about crop yields this year being down, and they will be down next year too. What with lower fertilizer use? So core food inflation may remain for longer. Would that be an inflation concern you would agree with, or are you worried about?
Yes, no, absolutely, I would agree with that, and it's one of the spillovers from the Ukraine war and the energy crisis. So obviously, the lack of Ukraine food production being exported around the world puts massive pressure on global food supplies, and obviously that's been eased by the way in which, to some degree, Ukrainian production can escape Ukraine and be exported to Africa. But that's also being held up, and you'll all have read about that. The mentioning of fertilizer is interesting and really important, and strangely, we forget how dependent we are on fertilizer, and of course that fertilizer itself is dependent on natural gas, the way it's made at the moment, because it needs quite a bit of hydrogen, and the hydrogen is separated out of natural gas currently. That's one reason why we need to find a cleaner source of that hydrogen, but we don't have one at the moment. And we just forget the direct link. Well, some of the more hidden links between natural gas and our well-being. It's not just about heating; it's actually about our food as well. And one of the two fertilizer plants in the UK, owned by CF Fertilizers, an American company that completely dominates UK fertilizer production, the one near Cheshire, one of their two plants in the UK has closed, and closed permanently, and the other one shut down for a period of time because of the gas price spike, and was massively bailed out by the UK government because it was of such strategic importance. They just had to pay to keep it open. It wasn't much talked about at the time, but these things go on behind the scenes, and clearly food and food production is something that we just all need to think a lot more about. And yes, food input prices have risen a lot, particularly agricultural commodities, and it's hard to see that reversing quickly.
Okay, thanks, Paul. Yeah, the next question we've got a bit more around valuation. So the question is, are there signs that investors now think that valuations are now fully reflecting macroeconomic conditions? Do you think the markets could soon start to look beyond the slowdown and become more optimistic? And what sectors would you like? And we have another one sort of slightly related to that in terms of, let's have a quick look. Where is that one? Yeah, what kind of indicators do you look for in the market that maybe we could be near some bottom? If there is any such indicator. I
wouldn't mind saying something about that, and maybe Scott wants to come in too, because obviously those are really fundamental questions and something we think a huge amount about at the moment. I mean, one of the unfortunate things is there's no bell that rings at the bottom or top of a market. So, we're in a messy period when there's still plenty of profit warnings. There's a lot more many more profit downgrades to come. I think that's pretty, it's got to be widely acknowledged. But the gist of what we were saying at the beginning in those context slides is, yes, we're at quite an extreme point, and the market in many ways is a bit like an elastic, and it stretches upwards on the bull markets and it stretches downwards in these kind of moments as we're in, and it tends to mean revert. So I think we're seeing some signs now that the prices have discounted a lot of what's going to happen. And in the last week or two, one of the signs I personally look for, and we discuss quite a bit, is how many companies are having profit warnings where the shares don't go down, in fact, where they go up. And we've seen at least a couple of those over the last week. And if you like, I see those as little olive branches being brought by a dove, and they're important signs. And we saw one from Genuit just a couple of days ago, and the shares started down and ended up on the day. The market won't turn around before we see that kind of thing happening. Where if a profit warning comes, it's unexpected. Of course, the shares are still being very badly beaten up. But where it's priced in and where the market was expecting something, that's the kind of thing you begin to see. So we are seeing that. I can't say this is the turning point, but we're at least building the ground towards that now, I think. Scott, do you want to add anything to that?
Yeah, I mean, I agree with all of that, and I think the important point about things no longer falling in bad news is something that we're spending a lot of time on. Obviously the slides that Paul presented earlier, the absolute levels of valuation are now extremely low compared to history, and even compared to the last financial crisis. So arithmetically, things look very, very oversold indeed. We don't yet have the confidence, and I think the recent kind of political shenanigans in the UK, it's very important this week that we get back to some level of stability. If we look back, say even just a month ago, we had no idea where interest rates were going to go. We had no idea where gilt yields were going to go. The currency was plunging. All of those things have now stabilised, and we believe that's quite important in terms of your future planning horizon and your future investment horizon. And ultimately, our job is to really look, years ahead. So we have to be planning now for what we think will be happening in a couple of years' time, rather than what's happening next week. And so we're spending a lot of time as a team thinking about areas of the market where the bad news is all on the price, because when things change, they do tend to change pretty quickly. And we have to be ready for that. So I think we've probably gone out of a very worried defensive mode within the portfolios, and we're now looking at where can we find opportunities, and where will the turnaround start from.
Okay, thanks for that, Scott. We've got one here you mentioned about political turbulence. Are there any particular stocks that were particularly affected by the political turbulence we've seen?
Yeah, I mean, probably. Yeah, I could probably take that, because a lot of the sectors I personally follow were hit very hard. For example, real estate. We're just doing an exercise looking at that sector at the moment. And that's a sector which has really been hammered in the last couple of months. As people have been worried, quite rightly, about gilt yields. Gilt yields are very relevant to the pricing of property as an asset class, and clearly, when they rise as rapidly as they have done, that causes quite a lot of pain. So most of the quoted REITs have fallen very substantially in recent months, to a point where they're probably trading at 40-50% discount to the last asset values. Clearly those asset values will come down as valuations reflect the market conditions. So we're looking at that as a sector, potentially where the political change may be in the price. But yeah, in general, there have been some sectors very hard hit, and they tend to be more economically sensitive ones. Also, the point about the confidence in the UK, clearly that had gone recently, and we can only hope that we're now entering a period of better stability. And if that is the case, then there's a lot of domestic assets which are, in theory, extremely lowly priced. So we have to be alert to that as well, I think.
Okay, thanks, Scott. I've got one quick question here about being the type of service it is, a BPR type service. Do you get the opportunity to get access to any overseas earnings and companies, or is that not really available?
If you look at the portfolio overall, approximately 50% of the earnings are out with the UK, or the revenues, should I say. We do analyse where the company's revenues come from. So it's about 50% non-UK. It's not true to say that it's dominated by the UK at all. I mentioned Craneware as an example earlier, and that's 100% in the US, for example. So the types of companies we invest in, we tend to look for a global perspective in the majority of them. So I wouldn't necessarily say that the portfolio reflects the fortunes of the UK. I think it's got a very broad global spread, actually.
It's very good. I don't think we have any more questions for now. Looking at the screen, I think we sort of covered them all off. So really just say thank you, Paul, thank you, Scott, thank you everyone for dialing in and listening. Hopefully that's been very helpful for you. If you have any other sort of further questions or queries you want to ask, then please do just get in contact with the sales team. We're all kind of listed there for you to see on the slides. And yeah, thank you again for joining.
Thanks a lot.
Thanks.
Okay.